Hey, Happy New Year, everybody. My name is Aaron Montell. I'm with Local Advantage Mortgage here in Denver, Colorado, serving the entire state of Colorado. Happy New Year to you. Who remembers 95.7 KISS FM in Denver? Who remembers that? Good old days, yeah. Hey, I'm here to share with you my 2023 mortgage rate and housing forecast. I'm not a big fan of the word forecast. I like the term expectations a little better. So, real quick, give me 15, maybe 20 minutes, and we'll run through this whole thing. And hopefully, I'll leave you with some realistic expectations of what to expect from real estate, residential real estate in 2023. Of course, 2022 was the year of inflation, if you will. It was the year that we all learned or relearned about inflation. It had been some time since we had to deal with it, the 70s, really, um, until 2022. It came back with some steam, didn't it? And why did it come back? Well, many reasons. That if there's one thing I like to say, it's that it's never just one thing, and it certainly wasn't. There was a pandemic, which prompted unprecedented monetary and fiscal support, which also caused what we now know as supply chain issues. Um, it, there was a shift in consumer behavior. There was a lot of things that went into inflation. Um, and really, I mean, it doesn't matter how we got here. The fact is that we're here. I mean, it matters how we got here, but let's just deal with where we're at, right? And the purpose of this slide is just to show you that inflation drives mortgage rates. Matter of fact, inflation drives all interest rates because interest rates are a return on a fixed investment. And if inflation is higher than it was when you committed your capital to that fixed investment, well, in real terms, your return on investment is negative. And nobody wants to invest money and not make money or lose money in real terms. So therefore, as interest rates, as inflation rises, interest rates must rise with it. Matter of fact, interest rates must outpace it, which is what we see here, because no investor wants to invest their capital into something and not see a profit. So that's why inflation is the arch enemy of fixed income, of bonds, and the like. And you can see here a very clear relationship, and it was one that, quite frankly, the Fed was hoping for inflation for many years. Matter of fact, from the period of the Great Financial Crisis until late 2021, the Fed was having a hard time achieving their 2% inflation goal. From the other side, they were having a hard time getting inflation up to 2% until late in 2021. And then, of course, the Fed, in all honesty, they fumbled the football here. They stuck with transitory far too long. They failed to act. They kept easy money policies in place far longer than they should have. There was really no reason for them to be buying mortgage-backed securities in January of 2022, but in fact they were. So while the Fed fumbled the football, they're trying to catch up with some rather aggressive actions. And in all fairness, a war in Europe wasn't in any of their models or forecasts, so that was something they had to deal with. But nonetheless, I think it's pretty easy and accurate to say that the Fed could have handled what the environment was a little bit better than they did. So moving forward, though, we are where we are. What do we want to see, and what do we expect to see? Well, because of those aggressive actions the Fed has taken the final 3 quarters of 2022, we are starting to see monthly prints of CPI, which is the headline measure of inflation. It's basically a basket of goods the average American consumer purchases every month, and what they pay for it. And we're seeing month over month, we're seeing high numbers from 2021 be replaced with lower numbers in 2022, and that started back in October with a 0.6 month over month. November saw 0.5. Now, December, January, February, March, we hope to see lower numbers. In December, the CPI print for December will come out about a week after recording this video. And while December 2021 was a 0.6, we're hoping December 2022 was a 0.5 or maybe a 0.4. So throughout the course of the year, we just hope to replace these higher numbers from last year with lower numbers this year, especially the April, May, and June numbers. As you can see, they were among the highest. And July also. So that's what we want to see, because then if we replace lower numbers on a monthly basis, then annualized, it comes down. And importantly, we watch core as well, as you can see here, noted in the headline there. Core, which strips out the more volatile things like food and energy, core is at 6% year over year, and we'd hope to see that drop as well. So what is in CPI? I think it's important just to mention that. As I said, it's a basket of goods, and one of the biggest components that I'm sure you and every other American spends money on every single month is shelter, whether it's rent or mortgage. The cost of where you live is probably among the, if not the most expensive expense every single month. And I want to point out that shelter costs, by way of the way they are measured, the way the data is captured, they're lagging. And so while home prices have come down, the cost to purchase a home has come down a couple percent over the last several months. 2-3%. Again, residential real estate is very geographically sensitive. So, what might be, 7 or 8% in the Pacific Northwest, here in Colorado, it's, I think it's 3 or 4%, something like that. So while it has come down, whatever the figure, it really has yet to show up in the official data because it's lagging as depicted here. Shelter CPI is lagging reality, right? So while real shelter costs may already be coming down, in reality, in the data, it takes time for those numbers to catch up. And we expect that in January, we're going to start to see that. And then moving forward, February, March, et cetera, that data continues not only to catch up, but to show a downward trend, a loss, momentum to the downside now, rather than the upside in shelter costs, which again are a big part of CPI. Already seeing lower costs in some of the other major components to CPI. Energy, of course, being the biggest one. Earlier in this year, we saw energy spike after the war in Europe broke out. Those costs have retreated and now are back to where they were this time last year prior to that invasion. So energy cost has come down. That is a big part of cooling inflation. Food is coming down, although I do think food is going to be a little bit sticky, meaning that it's going to, we may see it give back some of the exponential increases, but it's going to be sticky on the way down for global reasons. But shelter is 39% of the core CPI. So if we can start to see that data be reflected in a positive way, downtrending, we're going to start to see those inflation numbers come down. So why mortgage rates? Why did mortgage rates react the way they did to inflation? Well, as I mentioned previously, inflation is the nemesis, the arch enemy of bonds and fixed investments, because as I previously mentioned, if you bought a 5-year treasury, and I'm going to make these numbers up as I go, if you bought a 5-year treasury 2 years ago and it was yielding 2%, well, 2% isn't, you're not making money, you're losing money on that return today, because inflation is 6-7%. So in real terms, you're not making any money. Mortgage-backed securities are a form of a bond. They're a fixed investment. And there's more to it than that even because there's something in a mortgage bond, a component of it, of a mortgage called servicing, right? So, and you're probably aware of this, just maybe never heard it referred to in this way. You write your check to a mortgage company every single month. Sometimes it changes. Sometimes they sell the servicing rights to another company, and now you write your check to that company, or you make your bank withdrawal, your ACH to that company. Well, there's value in servicing because they're the company, they're the organization that need to collect your payments and pay your taxes and call you if you miss a payment and just manage your mortgage. And there's value in it for them. They get paid for that. Now imagine that you have a 7% loan that you originated sometime in 2022. Well, the market expects interest rates to decline over the next 3 years, 2 to 3 years, let's say. What does that mean? That means that you, Mr. Mortgage holder, you're going to have an opportunity to refinance your 7% mortgage for, say, 5% in the next 24 months or 36 months or 18 months, whatever it is. Well, that makes that value of that servicing less because the average lifespan of a mortgage in this country is 7 years. So they've done the math and they know that if the average mortgage is 7 years, they need, which is, what is that? 60, 74 payments, right? Am I doing the math right in my head? 60 plus 24, yeah, 74 payments, I'm sorry, 84 payments. They've done the math to know that if they collect 84 payments, their share of that, of those 84 payments is going to make them whole on the servicing side. Anything above that, well, that, is profit. And I don't know the exact breakdown, but they are expecting on average a mortgage holder to pay 84 payments. With the market expecting rates to decline in the next 24 to 36 months, well, that means that that mortgage servicer isn't going to get those 84 payments. They're maybe going to get 36 payments. And so to compensate for that, they're taking the interest rate needs to be higher so that you, the mortgage holder, pay a higher interest rate every month. Therefore, that servicer can take a bigger piece and make themselves whole. There's a little more to it than that, but in simplest terms, that's basically where we're at. And as you can see in this chart, it's a pretty historic spread between the 10-year, which is a barometer for mortgage rates, the yield on the 10-year treasury, the spread between that and the 30-year mortgage, meaning that if the 10-year treasury was yielding 3% and you were paying 5% on your mortgage, it's a 2% difference or 200 basis points. Historically, that's about where it's at. Earlier this year, we gapped out to 300 basis points because the market's expectation that you, as a mortgage holder, are going to have a chance to get out of that 7.5% rate and get into a 5 or 5.5% rate much sooner than the 84 months that is average, historically average. Therefore, it's basically front loading. And that's something we saw this year. And it was because of the pace of increase. They expect, while not such a fast decrease, they do expect a decrease, and they expect it to happen much quicker than the 7-year quote unquote normal lifespan of a typical U.S. mortgage. So the spread widened in order to make sure all the parties involved got the return they needed to get to not lose money. But that spread is starting to narrow. As again, you can see that historically it's somewhere around 200 basis points, which is 2%. And we've started to narrow, as you can see here on the far right. We were 300 basis point when we gapped out. It's now narrowing. The 10-year treasury went from 4.5% earlier this year. At time of recording, it's about 3.5%. And that's only helping the situation because if you think about it this way, if you have a 6% mortgage now, or maybe you're going to get a 5.5% mortgage at some point later this year, the probability that you're going to have a chance to refinance that 5.5% mortgage down to 5 or 4.5% mortgage, that probability is much smaller because that would mean interest rates would have to, fall even further. And we're expecting, the 10-year to flatten out somewhere around 3.5 this year, which means if we go back to a normal spread, you're looking at 5.5% on a mortgage rate. And at 5 or 5.5%, the probability that you're gonna have a chance to refi to a lower rate drops significantly. So therefore, those servicing values become more valuable, if that makes sense. So there's a little bit of market back end stuff happening here that led to such a rise in mortgage rates. But the good news is, as the spread narrows, mortgage rates will come down as that servicing value increases. So a little bit of behind the curtain there. I hope that made sense. I thought it was important to share. So what else is going on in the economy? Well, there's a recession coming. There's several indicators, and I'm pretty convinced that at some point we will see a recession in this country. However, the timing of that I've changed my expectation about in the last several months. Why do we think there's one coming? Well, the consumer's strapped. You can see post-COVID pandemic, credit card debt and other revolving debts, that's short-term debt, personal loans, etc., has just skyrocketed well beyond the level it was at in 2020, just prior to the pandemic. Of course, when everybody was stuck in their homes, credit card use went way down, but it's back, to say the least, as you can see in this chart. Also, savings rates, they did the opposite. People were stuck in the homes. A lot of people were given some money by the government. They couldn't go out and spend their money. They saved it. They've drawn those saving rates down to points lower than before the pandemic. So basically, plus inflation has made it hard on people. We saw gas over $5 a gallon for a time. Airline travel was higher. Hotel stays were higher. Food much higher. All of these things, people were paying more for the same basket of goods they did a year prior, which their incomes, some people have slightly higher incomes, but most are, within a few percent or so, not keeping up with inflation. So they had to dip into savings. They had to put it on credit cards. So the takeaway here is that the consumer is becoming strapped, really. Also, another reason we think that recession is coming is the yield curve. And it's no secret. It's been tried and true predictor for many decades now. When shorter term rates pay more than longer term rates, it's the market telling us that the economy is weakening. And we're seeing some of the deepest inversions we've seen in history right now. Now, the 10-year, 2-year is inverted, meaning the yield on the 2-year treasury or 2-year note pays more than on the 10-year treasury. Why would you lock up your money for 10 years when you can get more money locking up your money for 2 years? Or to the point of this slide, the 10-year 3-month is also now negative, about 80 basis points, which I believe is a record depth of inversion. The 3 months. So again, why would you invest your money for 10 years when you can lock up your money for 90 days and get the same amount of return? Also, and it's not reflected here, but something called the reverse repo, which is the Federal Reserve taking money from dealer banks on an overnight basis. It's paying 4.3%, whereas a 10-year treasury is paying 3.6%. So you can make more, if you're a bank, you can make more money overnight than you can investing in any duration. So it just speaks to the weakness of the economy. And when does a recession happen? Well, it happens when the NBER says it happens. They are the National Bureau of Economic Research, and they have a very specific definition of a recession. Contrary to popular opinion, the rule of thumb being 2 quarters of negative GDP equal a recession. I mean, fine, but that doesn't make it so. It's only so when the NBER says so. And a lot of times they say so, pretty much every time they say so after the fact. And what is that definition? Right here at the bottom of your screen. A significant decline in economic activity that is spread across the economy and lasts more than a few months. That means it's a decline that's widespread and lasting. We're not there yet. Employment is still quite strong. GDP is still strong. Consumer sentiment is still strongish. We're not there yet. And I don't think we'll get there in the first half of 2023. I don't. I think that you're going to really see the data show recessionary environment in the second half, and maybe even the first quarter of 2024. I do think that the can will get kicked down the road a little bit here, barring any outlier events. And I definitely don't think we're going to see them call a recession in the first 6 months of 2023. Just don't think it's going to happen. So what does it all mean for housing? Well, when interest rates rise at an unprecedented rate, which they did in 2022, it kills affordability. Yes, wages rose as well as a result of inflation, but didn't keep pace. And so affordability is out of whack. Real estate and housing has become unaffordable for a lot. And those people who it's become unaffordable for, where they're at? They're on the sidelines. They're waiting to see what happens next. They're waiting for lower interest rates. They're waiting for lower housing costs. Widespread expectations like that can become deflationary. And that's something to watch for too. I don't know about that yet. We'll have to wait and see how this unfolds. But basically, there's been a drop in household formations for these reasons I mentioned: affordability, people waiting to see, and therefore they're on the sidelines. So, and also, let's while there's a lot of people on the sidelines, new home builders are also slowing down. Of course, the cost of carry on residential real estate development, it's doubled. And so they have to be very careful what they invest in, because if they're stuck with something, the cost to carry is quite expensive for them. Also, I think they learned a lesson in 2006, 2009 about overdoing it. And quite frankly, it's risk control, but it's also supply and demand control. So I think the builders have learned a lot in the last 15 years or so. And to that end, they have slowed down. There's fewer starts, fewer applications for permits, and because of the things I mentioned earlier, household formations are down. Young people are choosing to wait to form households. Households that are renting are waiting to go out and become first-time buyers. Just kind of waiting to see what happens. There's a lot of talk about a housing crash. I want to be very clear about this. If you spend any time on the internet, if you spend any time on YouTube, there is a ton of fear mongering and clickbaiting about how badly the housing market is going to crash. Listen, in this country, I don't think that's going to happen. There's one thing you take away from this video, and thank you for your time watching this. There's one thing you take away. Remember, there is a very distinct difference between a crash and a correction. I think what we're going to see is a correction. And here's why. Over the last decade, people who have bought homes have had above average credit scores. They've been very creditworthy. And those same people now find themselves, for the most part, sitting on a ton of equity. Right? Do you see that parabolic move between 2020 and 2022 in the index here, meaning reflection of value? Those people are sitting on a ton of equity. They're very creditworthy and likely have an interest rate far below current market rate, which makes their monthly payment very manageable for most. So so there's not going to be um, a wave of foreclosures. Sure, some people will have job loss. Sure, some people will have to sell for a myriad of reasons. Absolutely. But they're not going to be distressed because they have a ton of equity. They can simply put that house on the market, and if it's priced right, it'll sell. Um, they're not underwater. While they may give back some, theoretical dollars between where the market peaked and where they might sell, the fact is that they'll be able to get out of that house and walk away with some equity if they have to. And so for those reasons, I think all this talk about a crash is unfounded. A correction, on the other hand, is what I do think we're going to see. And it's a very distinct difference. I think the correction we're looking for is somewhere between 10 or 15%. And it only makes sense. Prices rose, fine. It was offset by historically low cost to borrow, which made your payment affordable on a home that had risen significantly in value. That's gone. Now you have a home that's risen significantly in value, paired with interest rates, mortgage rates that have also risen historically, and your wages have, for the most part, failed to keep pace. So the affordability is out the window, and something has to give, and it can't be rates, at least not yet, because the Fed is in a fight against inflation. So interest rates, they're not going to give first. I think they'll give eventually, but they're not going to give first. What's going to give first is values, because that's what has to give. Your income, broadly speaking, income is not going to keep up and make up for interest rates that are twice as high as they were. What's going to give is values. And what are they going to give? Like I said, most forecasters, most real estate forecasters, and a few that I respect and follow are calling anywhere between 10 and 20% peak to trough, which means we've already started down that road. Not 20% from here, but 20% from peak. Personally, in the area that I'm in, the Denver metro area, I think somewhere between 10 and 15% seems reasonable. And quite frankly, corrections, they're necessary and they're healthy. If we had this parabolic line that formed between 2020 and 2022, if that parabolic line was to go twice as far as it did, then at some point the correction we would see would have been a crash. Corrections are healthy, they're necessary, and I do think one is here. And so with that, we'll move on to what I expect for housing. I also want to preface this by saying I'm a mortgage expert. I'm in tune with bond markets and economic development, stock markets. I'm not necessarily a real estate housing expert. If you want to get a detailed view of the area you live in, because again, residential real estate is very geographically sensitive, I recommend very strongly that you find a real estate professional whom you trust, and get their analysis and build your expectations from that. If you're in the Denver metro area and you don't have a real estate expert that you trust, I'd be happy to connect you with a few that I trust. Or maybe somebody in your family can recommend someone that they trust. But if you really want to know and build your expectations about real estate in 2023 and beyond, your home, your condo, your townhome, your rental property, your second home, find a real estate agent in that area that you trust and speak with them to build your expectations. Now, that being said, broadly speaking, here's what I see for residential real estate and for housing. Lower inflation. I think it's here. Has it peaked? I think it's probably peaked. Is it a straight line down? I'm not so sure. I think we may see a few surprises in the next several months for inflation. It's not going to be a fire alarm. It's not going to burn anything down. But I do think that it's not going to be a straight line to the Fed's 2% target. I really don't believe that. We will see a slowing of the economy, and eventually it will lead to an official recession. Again, I think that declaration probably won't come in the first half. Matter of fact, I think it'll come in the fourth or first quarter. I think they're going to kick that can down the road quite a bit. I think just the data will kick that can down the road and remain strong for a while. Also, incomes are increasing to help with affordability, but they're not keeping up. So, and matter of fact, this slide was prepared prior to this past Friday, where we got the latest BLS non-farm jobs payroll report, which showed that hourly wages ticked down just a tad. Are they rolling over? Too soon to tell, but they are weakening, at least according to one report, and one report does not make a trend. So we'll wait and see. But while incomes are increasing, I don't think they're keeping pace. And matter of fact, the data flushes that out. I do believe that inventory will remain tight for the reasons that I don't expect a crash. Very creditworthy borrowers locked into low interest rates. What's their incentive to move unless, they have to? So there'll be some instances of it, but, inventory will remain fairly tight, especially with the added story of builders slowing down a little bit for the reasons I mentioned previously. Rents are still expensive, which may push some people to consider buying, but rents are coming down. We're starting to see that now in the data. And where I'm at here in the Denver metro area, there's a significant number of multifamilies under construction, multifamilies being apartment homes. If you've driven through any of the populated metro, especially the downtown areas, all you have to do is look around for tower cranes. Each of those tower cranes, they're not building condos, they're building apartment homes. And when those all these units start to come online sometime in the next 12 to 24 months, supply and demand is proven time and time again to be the basis of economics. So as those units come online, I expect rents to just further come down. So that's basically where I'm at with the housing forecast. What about mortgage rates? Well, the Federal Reserve and central banks around the world are engaged in quantitative tightening, which is reducing the money supply, which is pushing interest rates higher. That is a headwind. If the Federal Reserve has been largely responsible for the increase in the quote unquote value of housing because they have artificially reduced the cost to borrow to buy that housing. So as that changes, it's a headwind for mortgage rates. Mortgage rates will remain high. We certainly won't go right back to where we were in 2020, 2021. And on that point, or to that end, rather, I do think the Federal Reserve will be slow to evolve and adapt. They've proven that that's their MO time and time again through the decades. They are incredibly slow to evolve to the environment around them. And I believe they will be this time. I think that they'll probably keep their foot on higher rates and QT. I think they'll push that narrative and push those actions too long. They may have already gone too far. We just don't know yet. So I do think that the Federal Reserve is going to be a headwind for mortgage rates, not a tailwind, at least not yet. And there is quite a bit of debt to finance, and always more debt, it seems, which is just going to be adding supply to debt markets. That's going to be a bit of a headwind. Tailwinds, lower inflation. I do think that inflation is coming down. It probably has peaked. Again, it's not going to be a straight line. There is some excess inventory, meaning there's some homes on the market now that honestly, I think the root of the problem, if there's whatever excess retail inventory exists, it exists because it's not priced properly. And so as reality starts to hit these folks, and these properties become priced more accurately, that inventory might start to wear off a bit. As I mentioned, the increase in servicing values. So as mortgage rates come down, the duration of the value for the servicer increases, which would only help mortgage rates come down even more, as I discussed. A recession is likely. I do think it's going to be in the second half, fourth quarter, even, and that recession is what is going to ultimately force the Fed to pivot. There've been a lot of talk about pivot. I think that the pivot talk is unfounded at the moment. I don't think the Fed pivots until there is a recession, not only a recession, but a recession declared by the NBER. And even after that, I think the Fed will be slow to react. So a big change in my thinking is that doesn't look likely that the Fed will cut their rates anytime in 2023. If they do, it will be in the fourth quarter, so not anytime soon. But all that being said, I do expect the 30-year fixed mortgage rate is going to move closer to 5.5%, likely in the second half of 2023, as those economic conditions begin to really slow and really appear to be recessionary. I think the 30-year rate will get down there around 5%. And I think the U.S. The 10-year Treasury in turn will push its way back down to 3%. And again, I don't think either of these things happen in a straight line, much like inflation prints. If we're currently at 6.5%, there may be a moment where we push 7 again on a 30-year fixed, and we're 3.5% on the 10-year. We may push 4% for a time, but I think ultimately throughout the course of the year, this time 2024, I think we'll look back and see that sometime in the course of the year, 5% or close to it was a reality, and the 3% on the 10-year is kind of where we spend some time. And again, that's probably the second half and even fourth quarter. So those are my expectations for the year. I hope that this short presentation led you to some expectations. Always feel free to reach out to me. You can email me at Aaron, Aaron, at Local Advantage Mortgage, or just visit localadvantagemortgage.com to get in touch with me there. Thank you for your time. Thank you for your attention. And I hope to hear from you. And if not, I hope you have a great, very happy and healthy 2023. Thanks again.